in the slide deck why I make such a distinction between the two lines of action. The topic itself is huge. There's no way we could give you everything you possibly need in the time that we've got. So we'll just hit on a couple of key themes. If they spark any thoughts, ask some questions. The session's going to be split broadly into half, 45 minutes, I think. I haven't run through them yet on the slides. Let's see where we get to. 45 minutes on the questions. And as Henrietta says, the purpose of actually being able to see you on the call is so that we can have a conversation about some of these things. Done many of these webinars where you just get a question on the chat and you never really get to talk about what it is that's on people's minds. So if you've got current issues, recent experience, then please share them. So what we're going to do, first slide, traditional, is a bit of establishing credibility. Who the hell am I? Some of you know me already. I've been around the Inspire network. So my name's Jim Shaw. I run Shaw & Co, which is an advisory boutique based in Bristol. We spend our lives doing mergers and acquisitions and funding them. So this is sort of straight down the fairway in terms of what we do. Myself, I've been doing it for over 15 years now in various different roles and guises. Background is accountancy, which helps obviously, but not essential. And done all sorts of transactions, mostly in the area of sort of between 5 and 100 million, so in the SME space. And I think we added it up the other day. I've done just over half a billion pounds worth of deals now, and I've been on the buy side. Actually, with the Voucher Cloud deal mentioned here, I was actually part of the management team that bought that out from Vodafone before we sold it on to Groupon. Sell side with Pucker Herbs, MBOs on buy sides, using private equity, debt, and all various things like that. So whilst I would never say there's something I haven't seen, then but I've seen sort of most connotations of M&A over the years. So first slide, and really coming back to the basics. Why would you actually acquire a business? I'm making the assumption that all of you are running your own businesses. You're working hard to grow those organically. So why might you pursue the opportunity to grow inorganically, as we call it? And there are good reasons and there are bad reasons. So some of the good reasons, a good reason to acquire a business is because it gives you an access to a product or a technology that you either don't have at the moment or would be very expensive to develop. It can give you the access to a capability which is similar but different, so know-how rather than or infrastructure rather than products and technologies. It might give you an access to a market that you can't otherwise penetrate, and that might be an overseas market. Quite common is for cross-border transactions to acquire market share in other countries if you're looking for international growth, or it might actually be to access something that is aligned with your business that at the moment that you're not necessarily active in, complementary business activity. Or it might be to give you access to customers. Quite regularly, businesses are required for their customer lists and particularly positions on preferred supplier lists and the like, although one has to be careful that those positions survive acquisition. And last, and purposefully last, is access to scale. And just reflecting on those good reasons for a moment, I've written them in that order for purpose. It's not accidentally, because actually the worst good reason to acquire a business, in my view, is to access scale. If what you're doing is buying something so you can do more of the same, you should be asking yourself the question, is it cheaper and does it present lower risk to my business to do that organically? Because you already know how to do it. you're trying to do more of the same and do it in your way. So when M&A markets are very, very buoyant, there is quite a lot of acquisition for scale. And there was quite a lot of acquisition for scale, probably more sort of 15 years ago. In recent times, it's become a lot less popular, particularly because of the advent of digital marketing and customer acquisition through digital channels. Means that actually most businesses, when they do the buy build analysis, find that actually the risks presented by acquisition don't lend themselves to doing it for the purposes of buying scale. Access to customers is almost another way of saying scale, but not quite. Where there's exceptions in buying customers are where a lot of those customers are contracted. So I'll give you an example where a lot of mergers and acquisitions happen simply because of the customer list. One of those would be insurance broking, for example, where books of customers are purchased almost daily. The washrooms business, in fact, I did a lot of work in my past for a business called PHS, where they were continually buying books of contracts, or managed service provision in IT. Those businesses are generally bought for their book. But unless you've got a contractual arrangement with your clients, then it becomes less compelling to buy revenue in that way. And actually, this is when the other elements of accessing markets, accessing capability, and accessing products and technology actually are more often than not the key drivers to acquisition. Conversely, bad reasons to buy a business. The top one, very much so, is because the opportunity presented itself. I have lots of people phone me up regularly, say, "Oh, this business has just come on the market. It's going to be a bargain, you know." And the first thing I always say to people is, look, just take a step back. Analyzing an opportunity is one thing, but if this business wasn't presented to you, would it have formed part of your strategic roadmap to purchase something that looked like this in order to grow your business? And if the answer is no, then you need to look long and hard as to whether this is the right thing for you to do. And there's lots of people that have bought things because it looked like a good idea at the time and have later regretted it, as we'll go on. Acquiring businesses isn't easy, and just because the opportunity presented itself is rarely a good enough reason to buy a business. Another bad reason is to save jobs. I think a lot of people like to think themselves the hero, but in business we have to look after those that are in the tent before we look after those that are out the tent quite often. And if a business has failed, and actually you're looking to acquire that in order to take on a workforce, for example, there's an underlying reason why that business has failed. And we'll come on to purchasing businesses out of admin later on, and it's key to understand why and actually taking a sort of philanthropic approach to it. Unless you have a very, very strong balance sheet in your own business, is often a bad reason to buy a business. You're making somebody else's problem your own. And the next one is because it looks cheap. If a business is for sale cheap, there's probably a good reason, and getting under the skin of that is important, and we'll come on to that. Again, the markets have a nasty habit of correcting themselves in terms of pricing. So, if it looks cheap, there's a reason. It's probably because you don't fully understand why it's priced like it is. And then the other one is because the guy that runs the business has annoyed you for years. And I put that one in there as a little bit of a tongue in cheek, but acquiring to take out competition, or just because there's an emotional side to it, because a business has found itself in trouble, or a business has got to the end of its life cycle and it's being offered to you, that sometimes just that feeling of superiority of having acquired it is not a good reason to go ahead and take on board a lot of the risks that go with acquisition. Okay. Moving on to the next slide. One of my favourite phrases, particularly used at the moment, is beware of catching falling knives. And the analogy, of course, is, you know, when a knife falls off the kitchen side, what do? You jump back, don't you? And you wait till it hits the ground and you wait for it to stop moving. Then you pick it up. You don't try and catch it on its way to the floor, because that ends up in all sorts of problems. And it's the same with acquisitions. And a lot of my narrative at the moment is focusing over the last 2 slides on the assumption that the business may have a problem, and a lot of acquisitions happen with great businesses that have no problems. But in the current environment with COVID-19, I think there is a greater risk of there being underlying problems, particularly if the opportunity is presented to you, it presents itself. And you've always got to ask yourself why it's cheap and what else is going on. Particularly if that business is being offered to you prior to administration, you've got to be really clear and understand that this isn't just on a downwards trajectory and you're making someone else's problem your problem, and actually you may be better placed to wait for that knife to hit the floor, as it were, i.e. for it to, you know, go into administration before you look at it. So, you know, say beware catching falling knives. Now, one of the things that I didn't state in my slide as a good reason to buy a business is actually to take competition out of the marketplace. And it can be. So, you know, if there's a competitor that you've been knocking up against over the years, and actually you want to bring those 2 businesses together, or you want to acquire that business to clear the path, then that's all well and good. But one of the things just to be aware of that a lot of people forget is that there's such thing as the Competition and Market Authority. And a lot of people assume that applies to you know, mergers like Sainsbury's trying to take over Asda, or big FTSE listed activity. It comes down quite a long way. In fact, I'm working with a client at the moment whose business was acquired, and very small business, 10 million turnover, and the CMA have deemed to reverse the acquisition, and they can do. If they think that the transaction has substantially reduced competition in a sector, they'll investigate, and they can force the buying business to then divest of the business that it's bought. And if you can imagine having to sell a business under the instructions of the CMA, and the fact that it's public information that you're under the instructions of the CMA, you don't get what you paid for it. So you can lose a lot of money very quickly that way. Now, market limits do apply with the Competition Commission, and any market that's under 25 million as a marketplace has a sort of de facto exclusion. But most people would probably say that their business operates in a market that is greater than 25 million in annual scale, and therefore you just need to put an element of thought around whether an acquisition would cause you a problem with the Competition Commission. And as I say, the reason I raise it is that most people don't even consider that it might apply to their business. But it's worth checking before you spend a lot of time, effort, and put a lot of investment into trying to undertake a merger, to then try and go for clearance and find out that you don't get clearance, or worse still, do it without realising and have the CMA knock on your door a couple of weeks after you bought the business and tell you that they're not too happy about it. Okay, so I'm going to talk a little bit about risks, and I'm going to balance it with opportunities, of course, because risk is by definition has an opportunity on the other side. Before we start to talk a little bit about process, and what are the key acquisition risks? And the first one is distractions. So I've worked with a lot of clients with growing businesses, and we all know from our own growing businesses, because it's growing, we and the people that work with us tend to be at the edge of the envelope in terms of their time in the day, what they can deal with, because we all do it. We all try and push our capacity as far as we can before we take on the next member of staff or the next team or whatever it might be, or put in place the next system. And buying a business is going to bring to bear and amplify a lot of those issues, both because of distractions of you as a senior management team trying to get the deal done in the first place, the distractions that come with integration up and down the organisation. Whilst I put this as a separate point, largely just to emphasise it, your management bandwidth is going to be sucked up, because one of the key steps in the acquisition process is the post-deal integration, and if you get that wrong, you can lose a lot of value in the deal. So before you go into the process of acquiring, you really need to have a long, hard look at your own business and make sure that you've got the capacity within the business to deal with the distraction and the increased pressure of integrating. I've been in a lot of situations where people have said, oh, I can just buy the shares and it will run itself over there. And no, that doesn't work, because needless to say, and we'll come on to another way of doing things in a minute, needless to say, particularly in the SME marketplace, if you've done a deal and you've bought out a key shareholder or key member of management, regardless of the amount of money they've got, inevitably their time and attention starts to wane because it's not theirs anymore. And we all know, as business owners and entrepreneurs, we put in more time, blood, sweat and tears into our businesses than any employee could be expected to do. And it's the same when you acquire a business. You've got to understand that there's a big part of that business that will be taken out. And that's got to be replaced, and it's got to be replaced from your business. Cultural alignment is also a risk, particularly if the strategy, and we'll come on to acquisition strategy in a while, is to merge those organizations in order to access either sales synergies or cost synergies. And in a lot of cases, you'll be needing to take on finance in order to make the acquisition work. That can be to pay the purchase price for the business, or if we are looking at something that you're purchasing out of admin where the purchase price may seem quite manageable, it's always the working capital that gets you when you buy something out of administration, and I'll come on to that a little bit later as well. Okay, so a nice bright orange slide to make sure you're awake. So, but what are the opportunities? I mean, getting an acquisition right can be transformational for your business. It can allow you to take a huge step forward in a very, very short period of time. You can achieve things in a matter of 6 to 12 months that might take you 5 to 10 years to do organically. You've also got that old phrase of 2 + 2 = 5, because bringing together organizations can lead to sales synergies. And what we call sales synergies will be anything that means that your revenue plus their revenue is greater than the sum of the parts. So the classic one is if you have a complementary product and you have a sales team that can actually cross-sell to both of the client bases. So, for example, in the FMCG space, you'll have a sales rep focusing on Sainsbury's, for example, but you might have an account at Waitrose. Well, your product probably could be listed at both, so your Sainsbury's account can sell both products and your Waitrose account can sell both products, and that's what we call a sales synergy. The more obvious one is a cost synergy, where we don't need 2 FDs, we don't need 3 accounts clerks, we don't need 2 offices. We can actually trim down the cost base and generate more profit than the 2 businesses, the sum of the 2 businesses put together. And I think just to take a moment on that, in the current environment, I do think that element of cost synergy and a reduction in general operational gearing for all businesses is going to be really quite important. So cast his sort of mind back to January. If we were all sat in a board meeting together in January and I put my hand up and said, well, let's plan for the possibility of a global pandemic where the entire economy is going to be shut down for 8 weeks, what we're going to do about it, you probably would have all laughed at me. If we say that, not that I knew it was coming, by the way, if you say that now, everybody will probably nod sagely and say, yes, we should understand, what's our strategy. And I think for a lot of businesses, ensuring that you've got a lower level of operational gearing so that when sales drop away, you've got a lower cost base to work with is becoming increasingly more important. So this idea of actually putting entities together to be able to reduce cost base, to reduce operational gearing is actually quite topical, and I think going to be increasingly important. And I think you're actually going to see a lot of bigger businesses over the next 10 years actually run much bigger balance sheets and much lower levels of operational gearing for in preparation for another version of COVID-19, which I think is just a matter of time rather than a question of if. Okay, so those are your opportunities. Next really is to think a little bit about the acquisition process, and it's not an easy one, but it's obviously possible. And the first part of that process is actually finding a target. Now, there's a stage that goes before finding a target, which is defining what that target looks like. Well, I couldn't get enough dots on my arrow, so you have to live with this one. And I always encourage people to, if you're thinking about building your business through acquisition, you should be able to write down what that acquisition looks like in order to achieve your strategic goal. Now, the truth is you'll never find that because businesses are unique, but you need to have a blueprint really to say that this is what I'm looking for, and without being distracted by trying to backwards engineer my criteria to fit the opportunity that's put in front of me, which is what we all do. But if you're thinking about that acquisitions might be right for you, over a cup of coffee this evening, blank sheet of paper, it might be worth you actually writing down what that acquisition target might look like. Put it in your drawer, and then when something lands on your desk, get that piece of paper out again and see how many boxes you can tick. And that will give you a better sense as to whether this is the right thing for you to be doing or whether you're just being purely opportunistic. Once you've got that acquisition profile, finding a target is one of the harder things to do, and we're often asked to help, and we can. But the definition of the right target is very much in the operations of the business, and really, it's only really the business owner when looking at another business that would really understand that yes, that business looks and feels right. It fits with my vision and where I want to go, and I can see us acquiring this. So there's a lot of legwork to be done in profiling your marketplace, reading lots of websites, doing research on these possible targets to come up with a short list, and opening the door to those targets is an art in itself. It's a bit of a sort of cloak and dagger world talking about acquisitions, and if you put yourself in the shoes of somebody you've identified as a target, if somebody phoned you up and said, I'm interested in buying your business, how would you react, and how do you actually build that relationship so you can get to a point of actually having a meaningful conversation about a transaction? And inevitably, when you're looking at a target, you won't have enough information to make a proper balanced judgment of the opportunity. So you've got to try and extract from that target enough information so you can do a feasibility study on the acquisition itself, so you can understand whether it meets your criteria, whether you believe that you're going to be able to finance the transaction, whether it's actually something worth pursuing further. And then comes the next challenge, which is actually agreeing the deal with the vendor. It is universally true that vendors think their businesses are worth more than buyers. It's just what happens. So you've got to try and bridge that gap, and it's particularly challenging if you have made the approach. People still have it in their mind that. Speak to many clients about this. Or just because someone approached me means they're willing to pay 10 times over the odds to buy my business. Well, that's not universally true. there is a right market price for the business still, and working your way to agreeing a deal can be some of the most challenging parts of the transaction. But it's one that you need to really invest as much time as you possibly can getting things agreed up front, because it's after that point the costs really start racking up for businesses looking to acquire, because that's when you start needing to really bring in professional help with lawyers and accountants and providers of finance, because then you're getting on the next stage of really spending some money without guaranteeing that you've got the deal. The way that the business acquisition market works is it's a bit like the house market. The deal's not done until the deal's done, and therefore you as a buyer spending money on due diligence, you're doing that at risk as you go through the process. And therefore, if there's going to be challenging deal items to get agreed, you want to get those agreed up front in a set of heads of terms, which we'll come back to on in a moment, before you start racking up the bill with your friendly lawyer and local accountant. Then, of course, there's securing the funding as well. Now, and this is where the transaction becomes a three-way transaction. I'll come on to funding a little bit more in a bit, but understanding what is fundable and what isn't fundable is critical as you're setting up the deal, because there's no point agreeing a deal with the vendor to find out you can't fund it, because then you have to go back around the loop again, and you end up making yourself look a little bit silly trying to unpick things that you might have sewn into the term sheet. And then there's completion, of course, the easy bit, and then the hard bit comes afterwards, which is making it work. But we'll talk about that. We'll talk about that then. Okay. So I haven't looked at the screen for a moment. Is everybody still with us? Yeah, great. Okay. Fine. I'm sorry that these are all a bit one way, but I'm not quite sure how to do it otherwise with the technology, but we'll get to questions in a bit. So one of the thornier parts of acquiring businesses, as I mentioned earlier, is actually deciding on how to value an acquisition. And when you're on the buy side, as we call it, say we're on the buying side, it's a lot more difficult than being on the sell side, because simply if you're selling a business, you take it into the market, you solicit bids, and the highest bid wins. Okay, fine. If you're buying a business, you want to be that highest bid because you want to buy it, but you don't want to overpay. And trying to find that balance of what is the right price for a business is notoriously difficult. What is also notoriously difficult is getting the vendor to agree what is the right price for the business. And there's a couple of ways to come at this. And I'd encourage people to be thinking about, what is the business worth to you? So when you've been doing your feasibility study should include a set of forecasts which look at cost synergies and sales synergies. And inevitably that business will have a value to you in your hands in terms of the profitability it would add to your business. And if you are growing your business with half an eye on an exit, you should have a good handle on what sort of EBITDA multiple your business should go for. So therefore you can say, well, hang on, look, if I buy this business, I run it for 3 years with these cost synergies and these sales synergies, I get this additional EBITDA, I multiply that by my industry multiple, I know what this is going to deliver to me, less my acquisition debt, of course, what this is likely to deliver to me in 3 years. And that really presents the cap on anything that you want to pay for the business, because otherwise you're going backwards, not forwards. It's also worth then trying to have a look down the other end of the telescope and what's the business worth to the vendor. And I've had situations, in fact, only a couple of years ago, where a client approached me and said, "Oh, and there's a client I've been working for a while." Said, "Look, I've agreed a deal to buy this business, and I'm quite interested. Can you kind of help me finalise the details and finalise the valuation?" And we did, and we started looking at it, and we felt that we were paying a very, very fair price to the vendor or offering a very, very fair price to the vendor, and the vendor was just absolutely dug in, heels in, that it had to be almost twice what we were talking about. And it was only a small business, so we were talking about acquisition price on this, I think, was 2.5 million. But when we dug and we started to realise what was happening, is that the individual was actually stripping out almost every penny that the business earned in a year. And whilst the open market value for that business was a 5 times multiple for the EBITDA, the guy couldn't afford to live on that because he was stripping everything out. And in 4 years' time, he would have spent all the money that we'd given him for the business. So he actually couldn't afford to sell it. The annuity value of that business was greater than its capital value. And when you start looking at acquisition targets, particularly smaller acquisition targets, it's really important to have a think about that, because if you end up in a situation where the vendor just can't afford to sell it, you're banging your head against a brick wall, because you're never going to come to a sensible price on that. And quite often it's the reason that they've got unrealistic expectations is because they're actually taking too much out of the business on an annuity basis. And this tends to happen with businesses that are later in their life cycle, tend to be more prone to this. So this was actually a business that had been established for 35 years, I think, and the individual was in his 70s, and he'd been doing the same level of profit for the last 10 years because he wasn't reinvesting any profits in growth. So he'd gone into that area, that phase where the annuity value was much greater than the capital value, and it didn't matter who he tried to sell it to, nobody was going to pay enough for him to maintain his lifestyle off the back of it, so it's just not going to go anywhere. The other thing is the theoretical open market value of the business. If you have a slightly more sophisticated vendor, and particularly if your vendor is being advised, that can be a good route to go down. There are techniques for valuing businesses, such as discounted cash flows. If you've got the data, multiple valuations, asset-based valuations, you name it, there's a whole art at trying to come up with a theoretical valuation for a business, and we do tens of them a year, well, hundreds probably when you add them all up. But the presenting a theoretical valuation to somebody who doesn't understand it is a bit of a waste of time. So sometimes you actually need to encourage your vendor to get some advice so you can break through the acquisition pricing discussion. And another element that drives pricing on acquisitions is competition as well. So, for example, just been working with a client recently who had a supplier that, or competition and need, I suppose, a supplier that went into administration, and if the company didn't purchase that company, a competitor was known to be bidding on it, and if that competitor withdrew the supply of that product, it would have put the company back between 6 and 9 months in terms of its development. So, when I was advising that client in terms of the pricing on it, we took the price we thought it was worth and added 50%, because that made sense, because it was an overseas purchase and it was a blind bid, and we just had to win it. So have we overpaid for the business? Yes, but actually, where it says here that the answer is somewhere above, we've overpaid for it because we knew there was competition, and it was worth twice to us what we paid for it, even though it's probably we've probably paid 150% of the open market value, if that makes sense. So there's no right answer in here. It's somewhere mixed in the above. Okay. The next thing to come on to when thinking about making an acquisition is buying a business is not as simple as price on day one, hand over the cash. In difference to buying most other assets, it's common for business purchases, sales, to have some form of shared risk. So commonly risk and then reward they don't pass on day one. So structures such as earnouts and carried interests are really quite common. And you should think really hard about structuring your offer to take advantage of those kind of structures, because they bring in better goal alignment between you and the vendor. Because the problem with an acquisition is you're both basically starting in opposite rings of the opposite corners of the boxing ring. You've got very defined roles, and trying to find areas of commonality and overlap in terms of goal alignment is really quite important to try and manage a lot of the risks around post-deal integration and actually getting the value out of the acquisition. And the other truth is, it's market. It's what a educated vendor should accept and should expect. And also, of course, it has the benefit of allowing you to self-fund an element of the deal. So it's not uncommon for an acquisition to be funded 70% upfront in cash and 30% in earnout, and for that 30% to actually be generated from the profits of the business during the period of the earnout. So actually, the business pays for itself. 30% of the business pays for itself, and that's very standard. And in terms of making sure you've got that goal alignment, it's really important you capture all this structuring in a full set of heads before spending money on lawyers' fees and due diligence fees. Shameless plug, you might want to spend some money on our fees helping you put that together, or somebody similar. But it's before the real costs start, you need to capture the deal, and knowing what's market in terms of structuring is really quite important. Okay, right. We're now going to just tip on to okay. So the next thing is funding an acquisition. I had a point, by the way, sorry, on here, just going back one. It did come back to me. If you buy a business out of administration, you have no opportunity at all for goal alignment between you and the vendor, because the vendor is the administrator, and the vendor will sell the business, the assets, sold as seen, no warranties, either cash on the nose, or they may accept some deferred payment, but they're not going to accept any kind of goal alignment. So when you price anything coming out of administration, you've got to remember that, and that's why the prices are so much lower than buying something solvently. Okay. Right. The next thing is funding an acquisition. Now, very few buyers of businesses actually have cash sat on their balance sheet. Some do, but very few. Therefore, needing to raise money in order to facilitate an acquisition is perfectly normal, and it's acceptable. But it needs to be thought about, and needs to be thought about quite early. And you're playing a little bit of a three-cup trick with funding, because an educated vendor, the first question they should ask you when you make an offer is, where's your proof of funding? Where's your money? Very rarely you're going to be able to say, hey, here's my bank statement, I can afford this. If you can, then fine, it takes this slide away. But 9 times out of 10, you're going to need a credible story about where your funding's going to come from, and engaging with a corporate finance advisor to help you put that together is going to pay dividends, because you're never going to be able to get an irrevocable commitment from a funder to fund an acquisition. They're always going to be subject to due diligence, subject to, but actually having at least some letters of support from finance providers can be really important to opening the door up to acquisition targets who inevitably want to make sure that you've got the ability to complete the deal. In terms of where money is at the moment, and obviously the current situation has had huge knock-on effects to the finance market as well as every other market, but the debt markets are still operating. So the people running those businesses, those debt funds, are seeking to look through the current issues. It may be the case actually that your business has done very well out of the current situation. There's winners and losers in the situation we find ourselves in. And for businesses that can demonstrate predictability on cash flows, then and that the scale of the acquisition you're trying to take on is within a certain ratio to your own scale, then the debt markets are absolutely still open for the right opportunities. we could dive into an entire different presentation here about the funding market, and those of you that have engaged with us in terms of our funding academy will know of my sort of funding rainbow. But the key thing here is that the person likely to give you the money to help you with this deal is not your bank. Acquisition finance for banks is far too risky at the moment, and you'll be, unless the scale between the two is so much so that the lend to your business is within very, very low risk levels to fund that acquisition. But then I might ask the question, why are you bothering with the acquisition? Because without trying to drift off too far, what we always say when we're selling businesses, and the same when we're buying businesses, is that you want to buy a business that's big enough to move the dial, because you're going to put so much time, effort, blood, sweat and heartache into it. There's no point finding out that it doesn't make a lot of difference at the end of the day. And you don't want it to be so big that it keeps you up in a cold sweat at night, because it can bring the whole ship down as it tips the boat over. So you've got to find that sort of sweet spot. And it's the same when you're selling a business. When you're looking at who your potential buyer might be, you need to approach people for whom you move the dial, but you don't cause a problem. So it's same the other way around. One interesting nugget of information that people may not have got hold of is that CBILS loans, the Coronavirus Business Interruption Loan Scheme, can be used for acquisition. That means that you don't get, obviously, the benefit of the guarantee there is actually given to the lender, but it does mean that lenders, a lot of lenders, will be prepared to lend in situations where they might not have done without that guarantee. Now, word of caution: if you pick up the phone to Lloyds or Barclays or HSBC and say, hey, some guy told me on a webinar that I can use a CBILS loan for an acquisition, they'll probably say, yeah, technically, but it's not within our bank lending policy. But there's a new market of lenders being accredited against the CBILS scheme at the moment, and they are a lot of the challenger banks and the alternative finance providers, and they will happily work within the rules to provide CBILS loans for acquisition, because they're not scared of ending up on the front of the Sunday Times like Lloyds is. For you can imagine the headline, can't you? Public money goes to help business owners buy bigger businesses, get richer and fatter. Probably even more so on the Daily Mail. But the point is that those high street banks won't do it, but a lot of the newer lenders will. And the truth is as well that your debt funding for an acquisition is likely to come out of what we call the alternative markets at the moment, as opposed to any of the main markets. And again, I hate to sort of do it unashamed plug. It's talking to people like us that are working in those markets and help guide you as to what is fundable, what sort of level of finance might be available to you from a debt point of view, and where are the providers. Now, if debt isn't available to you, then of course there's always the opportunity of raising equity. But it needs to be said that equity always takes a lot longer. You can raise a lot more money. You could probably buy a bigger business. It's not uncommon, actually, if you're looking at buying something that's of similar scale to you, that doing an equity raising in order to do that. But you're probably talking about 9 months to pull that off and get it all together. And the process of going through an equity raising at the same time as trying to do an acquisition will break most management teams. So you're better advised that if you have an acquisitive strategy that you think is going to need funding from an equity provider, to work on lining up the equity provider first, because they will come on board on the basis of creating war chests that you can go out and buy, and then you go and buy afterwards. It's not something to be done at the same time. Debt's slightly different. You can do them coterminously, but equity do first and then acquisition. And also don't forget that the funders' requirements are often very complex. So you need to be engaging in conversation with them very early to understand what you need out of the deal, particularly from DD requirements and structural requirements, covenants, warranties, etc. So they're happy to lend, and also what levels of security they're going to want on your existing business and whether that's acceptable to you. So therefore, when you get into an acquisition requiring funding, you've really got to see it as a three-way deal. Each party, you, the target, and the funder are equally important and need to be managed accordingly. Okay, on due diligence, basically do it. There's no substitute for it. When you're buying a business, there's no protection in law from you in doing a bad deal. So it's not like going and buying a car as a consumer, and you can make certain assumptions that it works, that it's not going to blow up on you, that it's safe. None of that in buying a business. It's entirely caveat emptor, buyer beware. So do your due diligence, don't make any assumptions. The documentation that you use to buy the business, the sale and purchase agreement, will always have warranties. And you might say, well, actually those can give me some level of protection. But within the UK legal system, warranties are extremely challenging to claim upon, because you have to demonstrate damage, and therefore you have to demonstrate loss. And if you go back to my earlier slide about the variability on pricing, it's extremely hard to say, well, this happened under a warranty, and had I known about that, I would have paid less for the business, when the mechanics that bring you to the valuation of the business are opaque at best. So, as I said at the start of this, I've been doing this for 15 years now. I've seen 3 warranty claims, and one of them has been successful. The purposes of warranties really are to drive disclosure from the business that you're buying. So you will, as the buyer, ask for warranties, and the business that you're buying will disclose the information against those warranties. And it's for you then to decide whether that information has an impact on the price that you've agreed. Don't think that warranties give you a retrospective price adjustment, because they don't. So not an alternative to DD. And areas that you should be thinking about in terms of your due diligence would involve financial due diligence. Definitely involves financial, definitely involves legal, could involve commercial, although you may feel competent in doing that yourself if you know the market, and it could involve technical, and you may feel competent in doing that yourself if you know the market as well. But you can imagine that it can get very expensive very quickly once you get into the due diligence phase. So you need to be confident you have a deal. You need to make sure those heads of terms that you've got are robust and complete, that you flushed out the major issues as early as you possibly can. And then when you're in the spending process of trying to do your due diligence, obviously you've got to stay very close to the vendor and make sure that they you keep that relationship. Now, in the way that most small to mid-market transactions work, that heads of terms will grant you as a buyer exclusivity. You should not be accepting a situation where you're doing due diligence, spending money, and you're still in a competitive bidding situation for the business. The only time that that's really acceptable in the SME market space is if it's an administration, because an administrator will never give you exclusivity on a transaction. But if you're doing a deal in the ordinary course, then you should be securing exclusivity so you don't have the assets sort of ripped from under you. Now, exclusivity will basically give you protection on these fees. So again, it comes down to costs and damages. But if a vendor sells the business to somebody else and you're negotiating with them and they've breached the exclusivity, the standard position is they pay all of your professional fees up to that point to put you back where you were. You very rarely will get management time back though, but you can protect yourself against third-party costs. Last couple of slides, I promise. So just on acquiring from admin, because that's quite topical at the moment. It can present huge opportunities and it can present huge risks. So I've said here it's sort of acquisition risk and opportunity on steroids. And get into that arena at your own risk. And I would advise, well advised, because I'm doing one at the moment, which is why I've been sat in this seat since Thursday evening. We've just bid on this morning. The amount of work you have to do in preparing bid and understanding all of the intricacies of how the creditors work, because when a business is in administration, it operates very differently to a normal business. So no longer is the business being run for the benefit of the shareholders, it's being run for the benefit of the creditors. And that means that different behaviours happen, and the way you price your bid on administration is very different as to how you price your bid when it's solvent. You can basically barter bid liabilities. So for example, if you bid to take on the all of the staff, although you've got sort of 2P issues to navigate as well, but if you're more generous then 2p necessarily requires, you actually take a liability off the hands of the administrator. So it's not just about picking a number, it's about saying, well, what's the barter transaction in terms of liabilities coming off an administrator. And I suppose a better example, actually, as I think about it, is maybe taking on a property lease. So when a business is sold for £1, very rarely is the administrator sitting there and saying, okay, I've taken £1 for this. He's sitting there going, well, okay, my landlord who had a claim for £1 million has actually now got a tenant in a viable business. So I've got £1 million back for this deal, not £1, if that makes sense for my creditor. Another thing to remember is prepackaged deals are really common, and they are very frustrating to third parties who see an opportunity to buy a business that's going into administration. Pre-packs are where ordinarily the management team of the business that's going into administration actually pre-arranges a deal with the administrator prior to it going into administration, and the business is actually only in administration for 30 seconds a minute as it's bounced in and back out by the administrator, which means the ability of a third party to bid is pretty much removed. Now, there are certain things that have been put in place to try and help with that. So, for example, SIP 16, where an administrator needs to prove market pricing, and if they've got any doubts in their mind, they may go out for an element of pre-marketing before doing the pre-pack. But sometimes it's very hard to get your oar in to make clear that you'd be willing to pay more than the management team might be for the asset. So it's common. I get people phoning me up saying, look, I think this business is going into administration. How can we find out what's happening? There is a process, and the start of that process is where a notice of intention to appoint an administrator is posted, but they are extremely difficult, if not possible, to find. So unfortunately, it's part of the system that the pre-packs do happen, and there might be something you've been circling around trying to get an angle on that you'll find has been flagged in and out the other side before you got an opportunity to put a bid on it. The other thing about acquiring from admin is that the asset you're buying is broken. Simple as. If it wasn't broken, it wouldn't be there. So you need to understand why it's broken and how you can fix it, and be confident that you're going to fix it. And the other thing to remember is that most businesses that come out of admin are cheap to buy, expensive to fix. So you've got to get your head around what is the working capital requirement, what's the investment requirements needed to fix this broken business on the other side of administration. And understanding things like ransom creditors. They may have been burnt by the administrator, but if you phone up the key supplier to the business and say, hey, I'm the new owner, can I have £100,000 worth of your product, please? They're going to say no, not until you've paid the old bill that's gone bust. So you'll find yourself doing a barter deal, even though it's not your liability because you didn't buy it. The vendor won't care because the vendor of the product won't care, because they're basically seeing an opportunity to leverage you to get money back that they've lost, and it's fair game. So you need to understand how ransom creditors work. Right, so that's the sort of whistle-stop tour on acquiring on acquisitions. The one last slide, penultimate slide that I just want to put up is that another thing to think about, particularly in the current market, is mergers as an alternative to acquisition. Now, a merger is defined, or certainly I define it, is where two entities come together with a common goal and effectively combine their equity. It's very different from an acquisition in my mind, because in an acquisition you have the dominant and the subservient, and there's a vendor and there's a buyer. In a merger, what you're actually saying is you're trying to bring two entities together with a common end goal, and that end goal isn't actually the merger. The end goal is maybe the exit in 5 years' time. And a lot of the points that I've talked about in acquisition remain true. Getting the relative valuations of the entities right, and the due diligence on each of the entities. And given that it needs to be doubled up, both parties, there is a lot of work in doing a merger. But it means that actually post-deal, you're much better aligned with the business that you've merged with than if you were a buyer and seller, where there's quite a clear win-lose situation over valuation. Doing it this way rather than buying a business can also make sure that you don't have to take on large levels of funding where there would be either that funding isn't available to you because the deal is a little bit too spicy for the funding market, or there would be debt servicing costs, which would reduce your capital available to invest in the business for growth. Now, one of the massive challenges with merging as opposed to acquiring a business is that there has to be a big change in boardroom culture, because in the SME market space, you're inevitably bringing together two entrepreneurs, two entrepreneurial management teams. You've got two silverbacks in the family now, and managing that change in culture for a lot of individuals who run their own business is actually the barrier. It's the largest barrier to merging, because they just can't see themselves working in a sort of committee-based way going forwards, because of course once you've done a merger, you need to make sure you've got the right corporate governance, you've got the right decision-making structures, and of course the autonomy and the power of the business owner and the founder is quite often diluted, and that in itself can be enough for some people to say no. But if you're happy with that as a change in culture, mergers, I think, are really something to be thinking about at the moment, because you can get all the benefits of of an acquisition in terms of sales synergies and cost synergies. You can reduce your operational gearing to better prepare your business for future funds. And if you can get over this issue of another silverback in the boardroom, you've actually got the two brains are better than one, because you're bringing into your boardroom huge amounts of experience. And then final slide, just to remember, is that once you've actually bought the business, that's when the hard work starts. So most acquisitions fail to meet the expectations of the buyer. Most feasibility studies that get done and then the actual financial results come out, they don't match. And the principal reason is failures in post-deal management. So making sure that you can integration plan is absolutely essential. Making sure you've got the capability and the capacity to do it is essential as well. So if you've got an already stretched organization, doubling its workload by bringing in an acquisition might not be the right thing to do. So if growth by acquisition is part of your strategy, you might want to think about growing your capacity and capability ahead of the curve, so you've got that available for when you get that, and it will be a spike, it'll be a rude awakening the day after you tell all your staff, hey, look, we've just built this business and we want to integrate supply chains, we want to integrate systems, we want to integrate finance, we need to take this number of people out. HR, by the way, you've got to do a whole process on 20 different people. If those people are already working full time, then it's not easy. So do think hard about putting that onto your organisation. And then that leads me to questions, which was, what was that? An hour? It was supposed to be 45 minutes. I apologise, but we got there.
Perfect, Jim, thank you. We've got two questions up. So our first one, do you have to refer any deal to the CMA?
No, you make your own judgment. So referral to the CMA is uncommon, but I flag it because there's quite a few examples of late where people have just not thought about it and have been caught out, and it gets hugely expensive. So the example that I'm working with at the moment, the person that bought the business has now spent £700,000 in legal fees trying to sort it out, which they can't recover on a deal they paid 10 million for. So 10% of the purchase price has just been spent on dealing with the issue. So most people will be able to look at a transaction and say, no, that's fine, don't worry about it. But I think it would be a mistake for me not to say, when running through the key bits, even if it's a 20-second thought that goes through your head, make sure you can satisfy that no, this doesn't need referral to the CMA. And if it might do, then do, because they will look at things pre-merger and give you a view. And also, if they've got a view that it does, then you're probably not going to win an appeal. It's the experience that I'd share.
Okay.
Jim, can I add something to that?
Of course.
Sorry, I've interrupted there.
And you're not there.
No, I'm not Claire either. Yeah,
I've got a very deep voice these days, Henrietta.
Yeah, I bought a business about 5 years ago, and we got caught out by the CMA. Nothing to the extent that you were saying about your client there, but they are fishing continually for fag ends of information. So they picked up in some small comment in considering we're in the golf industry, which is a relatively small comment in a relatively small publication in a kind of PR article about just some data. They're fishing all the time. They picked up on that and started a whole load of aggro on an acquisition that we made with regards to a buying competitor. So yeah, I think it's a really valid point you make. You can't underestimate that, because it's you think, oh, no one's going to be bothered about your business or what you do, but they're out there fishing continually for trouble.
Yeah, that's true. That's true. And the remedies they can come up with, the most extreme is to force you to sell the business, a full divestiture. They can force you to sell part of the business or whatever they or whatever they feel fit in order to restore competition to where it was prior to the acquisition. But hopefully 99% of the time it never comes across your desk, but you don't want to be the person that didn't think about it and ended up with the letter from the CMA, because unwinding these situations to their satisfaction is expensive, and you have a legal obligation to do it. They have the power of the law behind them.
Thanks, Jim. And the next question was Claire, who's now not there. Claire's disappeared. She asked about, you said that CBILS available for acquisition as long as you go through challenger banks. Would the same be true for a commercial property?
I'm sorry, Jim, I had to disappear for children. But yes, you were talking about them using it for acquisition. Would that apply to a mortgage on a commercial property?
Yes, so the CBILS structure is born of the EFG, the old EFG structure. So it's basically a rehash of much of that. And what has fallen over in that legislation is that the loan can be used for investment, and investment includes. So we've just secured a £2 million CBILS loan for one of our clients who wants to spend £500,000 on that on a new machine, and that's perfectly acceptable because it falls inside investment. Commercial property would be the same. It would fall inside an investment asset. If you have in the company a commercial property and you're thinking about using that as security and putting a mortgage against that property in order to fund an acquisition, where you may end up with an A/B choice with regards to CBILS is because what CBILS does have is a maximum 6-year term on it. And sometimes if it's structured as asset finance, down to a 3-year term, but there is a few tricks to get around that, which as opposed to taking a commercial mortgage on a 15-year term, it may look more attractive to do the standard mortgage outside of the CBILS. So the answer to your question is complicated, but a seemingly simple question: can you use CBILS loans to acquire property? Yes, you can, but you need to think through what's the best option and how you package that for the lender.
Thanks.
Great, thank you.
Any other questions? That's all that we've got in chat at the moment, Jim.
Okay.
Anybody else? Okay, well, just leaves me to say thanks ever so much for spending so much time with us today, Jim. And I will be able to share this recording with anyone that wishes to receive it, to show on to the rest of their teams. And I'll speak with you all soon.
Okay, thank you very much, everyone. And of course, I don't know if you've got contact details, but if you have any, Henrietta can sort that out. If you've got any follow-up questions, I'm happy to take them.
Fantastic, thank you.
Great, thanks very much.
It was really good. Thank you very much.
Thank you.
Thank you. Bye.
Bye.
Bye.